Joining me now is Carson Group Chief Market Strategist Ryan Dietrich. Ryan, you're right so far, but is it getting a little heady here? You think earnings season keeps the excitement going?
Yeah, we do, John. Thanks for having me back, and hopefully everybody's having a good week so far. Great discussion right before I joined, right? Sentiment, it's kind of mixed. You can find some pockets of optimism. We know the hedge funds and a lot of the big money institutions, though, have really missed this rally. That's one reason we think it can continue. But one thing to think about here, the second half of July historically is kind of a choppy month. You know, Warren Pies was on right before me. I love Warren. He talked about maybe a little choppiness. Maybe that'd be perfectly normal, you know, as we kind of catch our footing. And everyone remembers how volatile last August was with the yen carry trade unwind. If you go back and look, we still were higher about 3-4% last August. So I don't think the summer rally's done yet. Maybe a little break would be perfectly normal, John.
Where Warren is differing from you is he's taking his overweight off of equities, right, going to equal weight. That's what he told us here on Overtime some days ago. You're staying overweight, even though you expect that if there are some pricing effects, even inflation effects from tariffs, they're going to show up in a couple months. Do you just not expect those effects to be too serious?
No, that's probably the best way to put it. We don't. The inflation data today, even today, a wild day. Small caps down 1.5%. Yet you've got the NASDAQ at all-time highs. You can pick and choose that inflation data. The reality, we've been overweight equities, honestly, since the beginning of 2023. Right, I came on with you a lot talking about that. I was on last month when we set up summer rally. In April, we never cut our target, so we still are overweight. Well, one thing we've done from the start of the year to right now, we were very overweight U.S. We have gone more into developed international. We have gone more into Europe. So we think there's some diversification, if you will. And we actually are pretty heavy into large caps as well. Again, small caps underperformed today. We think large caps will probably still do a little bit better, and that'll still benefit investors the second half of this year.
Where are you going for international?
Yeah, specifically Europe. Some of the big ETFs. We look at Germany. What Germany started doing back in March when they were all that spending with their GDP and defense spending. We said, what are the four most dangerous words? This time is different. Search on Templeton. We said this time is different. Europe's finally starting to do something there on the fiscal side, and everyone, it's a dirty word, deficits. We understand that, but look historically, when you have fiscal deficits, you tend to have higher corporate profits, and you tend to have a better stock market. That's what we're seeing in Europe and starting to see it in the U.S. as well.
Do you believe in AI? Is that why you think it's okay to continue putting money into U.S. equities at a time when valuation-wise, price to earnings, things appear to be out of whack? There's the theory out there that because tech is doing a lot more, big tech is doing a lot more as far as pulling weight overall in these indices, they deserve a higher multiple.
Well, we're in that camp, too. Like I said, we're overweight large cap. So by definition, if you're overweight large cap, you have a lot of tech exposure. So we do think the AI theme is still alive and well. And I know financials got beat up today, some more company-specific things. There's still some reasons, though. We're overweight financials, overweight technology, overweight industrial. Some of those cyclical areas, John, we still like. And put a bow on it, we like momentum, those momentum ETFs. We think those are some areas that have done very well for a while. And that's a nice place for a lot of investors to buy kind of that theme, if you will, for the second half of this year.